Hello, everyone. We are just letting everybody in to the webinar, and we will start shortly. We have all the speakers ready, and we see there are many people in the waiting room. So my colleague Aisha is just letting them in. And as the numbers go up, we will start in a few seconds. So as usual, welcome, good evening, good afternoon, good morning from wherever you're joining. And please feel free to introduce yourself. Emojis work really, really well in these webinars, and we love to see those emojis and responses. Introduce yourself, especially from where you're from and what you're representing and what your interest is in the local government, subnational financing with blended finance structures. So on behalf of WAPPP, I'd like to welcome you to today's webinar, Local Government-Led Blended Financing in PPPs. This session is part of our ongoing 2025 theme, Mobilizing Blended Finance for PPPs. This is a critical area of focus for enabling more sustainable and impactful PPPs. To open today's session and set the stage, I am pleased to introduce a key member of WAPP's leadership, Jinan Ghosh. She will offer opening remarks and guide us into the discussion. Jinan is an associate director at Jacobs Middle East, specialized in infrastructure advisory and PPP. So she brings a wealth of experience in this field. And she also serves as the executive committee member of WAPPP. So over to you, Jinan. Really excited to see you.
Thank you, Jyoti. Thank you, everyone, for attending today's session. I'm very happy to be here and also to be part of the Blended Finance program since its inception. Today's discussion will focus on a critical yet often overlooked aspect of blended finance, its role at the government and subnational levels. Around the world, municipalities and subnational entities are on the front line of infrastructure delivery, responsible for more than 60% of public investment in infrastructure and services, according to the OECD. Yet, these local actors frequently struggle to access private capital. Limited fiscal space, weak credit profiles, and gaps in institution capacity create persistent barriers to investment, particularly in emerging and developing economies. Blended finance can help bridge these gaps. By combining concessional and commercial capital, it offers a way to de-risk projects, improve their bankability, and make smaller-scale, community-focused PPPs more viable. While only 13% of blended finance transactions to date have involved subnational actors, according to the Convergence database, that share is growing, especially in sectors like clean energy, water and sanitation, and urban services. Local government often bring deep knowledge of community needs and strong development impact potential. What's often missing are the right financing tools and support structures to bring their projects to market. This conversation comes at a crucial time. Cities are navigating the intersecting demands of urban growth, climate resilience, and equitable access to public services. Yet the financing gaps remain large. Less than 20% of subnational governments in emerging markets are considered creditworthy locally, and just 4% internationally, according to the World Bank and Global Infrastructure Facility. This disconnect between urgent need and financial readiness is a key challenge, but also an opportunity for innovation. Development finance institutions, philanthropic actors, and forward-looking public agencies are piloting models designed to the realities of the subnational finance, from pooled funds and guarantee mechanism to local currency facilities and technical assistance for project preparation. Today's session will highlight that with the right support, local governments can unlock domestic capital and lead on infrastructure solutions tailored to their communities. We'll hear from public agencies and practitioners who are pushing this agenda forward. Through concrete examples and policy insight from places like Sao Paulo, Kigali, and beyond, we'll explore how local governments can harness blended finance to deliver high-impact, resilient infrastructure, and what it will take to scale these efforts in the years ahead. To guide us through today, I'm pleased to introduce our moderator, Neil Dott. Neil is the Executive Director of AquaFed, the International Federation of Private Water Operators. He brings extensive experience in public affairs, water sector policy, and communications, having held leadership roles at Water UK, Euro, and UK Financial Services Authority. The floor is yours, Neil.
Thank you, Janan, and hello everyone. I can see already we're almost in the 90s with the participants, which is awesome. Thank you very much for coming. It's a real pleasure to be moderating today's important discussion on local government-led blended financing in PPPs. This is a topic that's not only timely but very relevant to me and Christina, who you'll meet shortly, because we work in the water and sanitation sector, the WASH sector. Now, around the world, basic infrastructure, especially water and sanitation, is managed at the local level, often by municipalities, and regional public authorities. So local governments are key actors, but in achieving sustainable development goals, they face real challenges in accessing finance. Now, we're going to briefly touch on the WASH, the water and sanitation context today, but the insights and strategies we'll hear are kind of applicable across all sectors, from education, healthcare, mobility, climate resilience. Okay, so here's how today's session will unfold, excuse me. So we're going to begin with a presentation by Convergence, offering a data-rich overview of local level blended finance activity and key market trends. Next, we're going to hear from the municipality of Sao Paulo. So we're going to go from kind of academic level right onto the streets of Sao Paulo, which we're going to showcase its PPP portfolio. It's an excellent example from Latin America's largest city. Following these presentations, we'll move into a panel discussion with our expert speakers. Then we're going to open the floor for audience Q&A. And I must say, please do give us your questions throughout. We really want an interactive experience here. This isn't, don't just sit quietly and listen. Really throw the questions at me and all the speakers, please. Just some housekeeping points. To repeat what Jyoti said a few minutes ago, please introduce yourself in the chat with name, organization, and country. And LinkedIn profile as well is also very, very helpful. And as I said, during the session, submit your questions, any comments. Let's have the interactivity going as well. So now, without further delay, I'm going to introduce our first speaker. It's Akif Merchant. He is the Director of Engagement and Capacity Building and the Head of Africa at Convergence. Akif collaborates with governments, development finance institutions, and investors to scale blended finance solutions around the world. He brings hands-on experience across Africa, Asia, and Latin America, and is a leading voice in embedding blended finance into both policy and practice. Akif, a big welcome to you. The floor is yours.
Great. Thank you, Neil, for that generous introduction. It's wonderful to be here with all of you. And thank you to the World Association of Public-Private Professionals for bringing us all together and for really putting blended finance at the heart of your learning agenda. Caroline, can we get the slides up, please? And as Caroline gets the slides up, I'll introduce Convergence, I'll introduce myself. Convergence is the leading institution and organization focused on blended finance practices, blended finance policy, really working with institutions, investors, project sponsors around the world to increase the uptake of this financial structuring approach. My name is Akif Merchant. I'm the head of Africa at Convergence, based out of Kigali, Rwanda. Before we start, just a quick bit of first principles comment. Blended finance, as Jyoti mentioned at the outset as well, is a financial structuring approach. Public-private partnerships are a contracting approach. Public-private partnerships may or may not be blended. The devil really lies in the details. It's important for us to look at the terms and conditions to see if there's concessionality embedded within a PPP for it to move into the realm of blended finance. So one is a structuring approach, one is a contracting approach, and then they can be mutually exclusive. Caroline, next slide, please. Now, at Convergence, we look at a range, we map out a range of different transactions across the ecosystem. We've captured in our database around 1,600 odd blended transactions. And as Janan mentioned at the outset, there's only a small percentage of those that have a link or are part of a subnational issuance or a subnational transaction. We are seeing this trend grow and increase over time, but it does remain a contained subset. And I think no surprises for guessing, the WASH sector, the energy sector are the sectors that are most aligned to subnational blended finance transactions. Caroline, next slide, please. as you can see it on your screen. And maybe next slide, please, Caroline, if you can move along. So what I want to do, Caroline, can we go on to the next one, please? So what I want to do is really walk you through two examples of good practice blended finance transactions that we see serving as a good archetype or a good model for standardizing and scaling up subnational blended finance transactions. And the first one is from India. Next slide, please, Caroline, and maybe the next one as well. You can just skip through this one and go into the schematic. This one is the Tamil Nadu Water and Sanitation Pool Fund. I know there's a lot going on here, but let's work on this and work through this together. So imagine a pooled bond issuance issued by the Water and Sanitation Pooled Fund. So it issues a bond issuance that's subscribed to by a range of different institutional bondholders that are domestic in India. I believe this was in 2005 or 2003. Now you've got this bond issuance and the borrowers, the underlying borrowers, are 13 urban local bodies that have come together to access these domestic capital markets. Now the bond is issued and the proceeds are on lent to these 13 urban local bodies to finance various different infrastructure projects, most of them in the wash sector. This bond is AA rated with a coupon of 9.2% and a maturity of 15 years. And as you can imagine, a rating of AA essentially means that this is an investment grade instrument or investment grade product for domestic institutional investors to participate and to subscribe to. Now, how did we get there? Because this bond was not collateralized. So we got there using blended finance. We got there using 3 levels and layers of credit enhancement. And by the way, I should also mention that the bond had a put and call options layered on top of them so that investors could cash out after a 10-year holding horizon. So as I mentioned, this bond is unsecured. However, with the multiple layers of credit enhancement, we were able to get this to a AA rated instrument. So follow along and you'll see at the top, right at the top, the Tamil Nadu state government essentially capitalized a debt service reserved fund, which helped inspire and instill investor confidence and assured them that the fund would continue to pay creditors even if the ULBs were unable to make their scheduled payments. So you've got the government coming in and essentially putting money into a debt service reserved fund, which could be called upon in case the ULBs are unable to make their scheduled payments. And in turn, that debt service reserve fund had a partial guarantee or benefited from a partial guarantee, which was supplied by the United States Agency for International Development Credit Authority. The second layer of credit enhancement was provided by the escrow account. And as you can see here, the escrow account was essentially an account that was legally required for the ULBs to establish one of these, where a proportion or a portion of project cash flows were essentially directed and diverted to this account. So you've got the state government putting money into a debt service reserve fund. You've got the ULBs through the project cash flows essentially sending money to an escrow account. And then the ULBs also had to divert a portion of their tax collections, a portion of their revenues to another debt service reserve fund that could have been accessed in the case that the escrow account did not have the right amount of sufficient capital in it. So you've got the Tamil Nadu government putting money in, you've got an escrow account, which is got some project cash flows that are ring fenced, and then you've got a separate debt service reserve fund that is capitalized through urban local body revenues. And so with these 3 layers of credit enhancement and the DCA guarantee, you essentially got a level of comfort, a level of security, a level of guarantee essentially for these bondholders, for these institutional investors who are much more comfortable to invest in this transaction than they would have been otherwise. And as you can see, by pooling various different ULBs together into one specific issuance, you are able to diversify as well across a range of different sub-geographies in Tamil Nadu, as an example. Next slide, please, Caroline. Maybe we can go on to the next one as well. Let's just go to the schematic in the interest of time. So this is another example of a pooled fund in action. Essentially, you've got, this is the Subnational Climate Finance Initiative. managed by Pegasus Capital. You've got essentially a blended tiered fund structure. You've got 2 tiers of capital, a first loss concessional tier provided by the Green Climate Fund, and a senior tier that was capitalized by commercially oriented investors. And this cumulative of 750 million is being deployed as equity across a range of different projects, the underlying projects being in the wash space, in the renewable energy space, and so on and so forth. And alongside this equity infusion, these projects are then raising debt and additional co-financed equity from the various different commercial lenders and the development finance institutions and the MDB community. And separately, there was a grant facility, a technical assistance facility capitalized by the donor agencies that was used to prepare projects, that was used to build capacity of the project developers, and used for impact monitoring, reporting, and verification. Next slide, please. Essentially, what you'll see is the following. You'll see a trend towards pooled, next slide, please. You'll see a trend towards pooled financing, diversifying across projects, diversifying across currencies if possible, and diversifying across countries. And with diversification, with some subordination within the capital structure, and maybe a few additional layers of credit announcement, you are able to take essentially a non-investment grade credit risk all the way up to investment grade through these various different blending modalities. Essentially, what we try to do through blended finance is to shift risks or to reduce risks and or enhance returns. That's essentially what we're trying to do so that we reduce the weighted average cost of capital for these transactions and get transactions off the ground and get them to the point of bankability as compared to what they would have been otherwise. We've done a lot of work on this topic at Convergence, and we are continuing to push for this concept of scale and standardization. And so once I finish my remarks, I will post some of our work on subnational blended finance in the chat box for all of you to consume. But I'm happy to take any questions, and hopefully these examples were illustrative of where the ecosystem is going towards and what the trends are when it comes to scaled issuances and trying to get really low cost of capital financing into the hands of subnational governments. So with that, I'll yield the balance of my time back to you, Neil.
Thank you, Keith.
And happy to answer any questions.
Yeah, that was excellent. I loved the tour of the Tamil Nadu kind of structure. That was excellent. I think everyone would have enjoyed that as much as I did. Akif, there was one question for you actually before I let you go from Jyoti. I saw in the question. She was asking with the AA rating bond, sorry, AA rating for the bond. What was the Tamil Nadu government credit rating?
Yeah, it's a good question. So the Tamil Nadu government rating is not AA. It is so the Indian government rating is around BBB minus. So the state of Tamil Nadu is 1 or 2 notches below the Indian government rating. Okay. But so this bond essentially is several notches higher than the local state of Tamil Nadu and even the sovereign entity. And we've seen this time and again, with diversification, you automatically get a 1 or 2 notch ratings uplift. With subordination and credit announcement, you can get a 1 or 2 notch ratings uplift. So that's really the power of blended finance. And that's really why we wanted to highlight some of these examples, because essentially when we speak to investors, investors say, look, all this is great, but I have a fiduciary responsibility. I'm talking about insurance companies and pension funds. Give me and put in front of me investment grade product that I can support. And that's really what we're trying to do. And that's really why I want to highlight these 2 examples.
Brilliant. Okay, thank you very, very much. That's excellent. Really enjoyed that. Thank you. Right, we're going to, sorry, that's just as I do that, my phone rings. So we're going to go straight from India to Brazil now, right? Stella, so welcome to you. It's my honor to welcome Stella Coimbra. She's the next panelist presenting the Sao Paulo Parcerias pipeline. I've pronounced that really, really badly, Stella. So first of all, if you could actually tell us how to pronounce that, because that was a terrible job by me. And basically, you're going to talk to us about the use of blended finance to deliver PPPs in the city, which we're very interested in. Stella, over to you, please. Thank you.
Good morning, Neil. That's parcerias. I believe that
it wasn't that difficult,
Portuguese.
Was it? Actually, yeah.
Yeah, Portuguese is not a very well-known language, let's say. So good morning, everyone. My name is Stella. I'm a project director at São Paulo Parcerias. It's a municipal PPP unit here in São Paulo, Brazil. And I'm going to share a presentation just talking about all the issues we are discussing here today. So just a second. Okay, does everyone see my screen? Okay, excellent. So São Paulo Parcerias is a state-owned company controlled by São Paulo city government. We are the largest subnational PPP unit in Brazil. We are probably the largest PPP unit in Brazil. We have over 55 signed contracts. Not all of them are PPPs, that's important to say. So there are diverse projects here, but our focus is mainly on education, parks, urban renewal in general, public facilities, and we do the whole cycle. So we do the project preparation, that's what we are known for, but we also support the contracting parties in monitoring and managing the contracts. And we are also exploring performance and impact evaluation. So that's like a new frontier here for more mature projects. We have brought over $2 billion in economic benefits for the city since 2017. So it's a very successful initiative by our local government. But talking about Brazil specifically, Brazil is a very big country. We have over 200 million people. We are the largest country in South America, and we are a federation. And that's a little bit part of the conversation here, because states, federal government, and municipalities, they have a lot of autonomy in different jurisdictions. So for example, usually municipal government does not deal with water and sanitation projects. That's a state level jurisdiction. Energy is something that, especially energy generation and distribution, something that is taken care by the federal government. So as you can see, our portfolio is more focused at the city level, the things that people really see and are concrete and are in their daily life. So here in Brazil, we can say that we have right now a portfolio of almost 3,000 infrastructure projects, and 68% of the granting authorities are municipalities. So that shows the size of the subnational sector here in Brazil, and also the fact that we have almost 6,000 cities doesn't help. So it's a big country. So talking about infrastructure financing, it's important to say that there are a lot of initiatives by the federal government to help subnationals develop their PPP sector, which is kind of a new thing here in Brazil. Traditionally, all the investment made in infrastructure has been public, 100% public, with traditional contracts, public works. So the presence of private investment in infrastructure is something that happened in the last 20, 30 years in Brazil. And we have updated our legislation to try and keep up with new arrangements. We have public funding for training public agents. That's a very interesting initiative. So when banks loan money to infrastructure project, a percentage of this amount has to go to training for public agents. So that's a way to improve the quality of projects, not only of the projects themselves, but also the selection of projects. We have public funds also for project preparation. So as you can imagine, not all cities are, like São Paulo, they don't have a dedicated PPP unit. They don't have qualified people or even time or infrastructure to prepare projects. So there are also federal government initiatives to help that. And there are some level of coordination by the federal PPP unit, but not as much as it could be. But also the fact that the country is so big and there are a lot of autonomy, I think that's kind of expected. So it's harder to coordinate and to centralize initiatives. Who finances infrastructure projects here in Brazil? Mainly BNDES, our National Development Bank. It's the main financing body. We also have private banks and regional funds and some capital market, but still BNDES is the main financing body here in Brazil. There are other tools to finance infrastructure. They are relatively new, so the market is growing. So for example, there are incentivized debentures and infrastructure investment funds, but this can certainly, there is a huge space for improvement here with these tools. We have a relatively stable market. I mean, I can only compare with other Latin American countries, but that's good for investment. Brazil, I'm not sure about Brazil, but São Paulo has investment grade rating. So we do have AAA here locally and BB for global rating. We can see that the level of public investment throughout the years has remained stable, but the level of private investment in infrastructure has risen considerably in the last couple of years. So that's a trend that we hope to continue and foster here in the sector. Well, I think it would be interesting to talk a little bit about São Paulo. So São Paulo is a huge city. It's 12 million people. It's not the largest in Latin America, because Latin America includes Mexico, and Mexico City is bigger than São Paulo, but it is the largest one in South America. And our revenues are the biggest ones in Brazil, and we answer for 10% of Brazil's GDP. We have right now 66 ongoing public-private infrastructure projects. It's a huge portfolio, and I'm gonna just highlight some of the projects that we are working on and that have this aspect of blended finance. So here we have projects that mostly what the city did was to contribute with a part of the capex of the project during the construction phase. We learned that this is a very efficient tool to attract private investors for projects. So we do put a public grant during the construction phase that lowers considerably the risks for the enterprise, and we are able to attract more competitors. So some of the projects that you can see here, South São Paulo are like they are like huge schools, 12,000 square meters. They're very big. They are actually a hub for the communities. They are usually located in disadvantaged communities. In this case, we have almost $200 million in capex, and I believe 62% of this amount was given by our local government to the private partner during the construction phase, obviously respecting certain milestones and everything.
Stella, I'm sorry to just jump
Yeah.
in. If you could just wrap up in about 30 seconds, I do sorry. And also I've got 3 questions for you I wanted to ask you quickly as well. So I'm sorry to interrupt you, but yeah, sorry.
Okay. So I have some more projects to talk about, Neil, but I won't. I'm just gonna show you what's going on here. We have a huge portfolio, as I said. We have some international bodies financing projects as well, like the IDB or even the National Treasury. And we have some upcoming projects also. They're not huge, but they're big. And I would like to invite everyone to get to know São Paulo Parcerias and our portfolio and bring these foreign money here to Brazil. We are worth it.
Stella, thank you. Brazil is definitely worth it in every single way, as you say. Well, I've got a couple of quick questions for you then. What I might do, Stella, actually, because that was so interesting, and I know you haven't had much chance to give some of those examples, but at Aquafed we do a monthly call which is connected to WAPP because we're members of WAPP, and we have guest speakers on, and maybe we can take on some of those examples and give you another chance to present some of those because we'd like to see them. And try and get people back for a kind of round 2. And I'm really sorry that you've had to kind of feel a bit rushed. So if that would be okay, I'll take that offline with you. Just some quick questions that were given to you in no particular order. So Christina was going to be talking in a minute. She's asking you, what's the interest rate offered by BNDES?
I don't know from memory because São Paulo has a very peculiar position. We haven't used our federal government financing mechanisms yet. We used our own money so far. We may have to try to use BNDES in the future, but it's lower than private banks in general. So right now, our interest rate in Brazil is huge. It was just gone up to 15% yesterday. So it's not very interesting for getting loans. And I believe BNDES offers much more competitive, much lower than these 15%.
Great. Okay.
We are.
Thank you. 15%. Wow. Okay. Jyoti is asking, does your city have a project preparation budget? That was really interesting when you were talking about that. I hadn't heard of that happening before. That's really good. So what is the project preparation budget? Because you mentioned the training element as well, but is there a rough size of the?
Well, we are a company controlled by the government. So the government here hires us and they pay us just like any other contractor. So right now we are looking at around 30 million reais as a budget for us this year, and we are the ones who prepare the PPP projects for the city. So yeah, they pay us, and we are independent financially, and we render services to other entities, so to other cities, other states. So we also have revenues from other places.
Okay.
Yes, and there is a fund for smaller cities who don't have this kind of structure inside to finance project preparation.
Okay, brilliant. So I'll also give a bag of sweets to anyone who can quickly convert 30 million reais into dollars or pounds as well. So I can't quite remember what the rate is. Right, Stella, I'm very sorry. We need to unfortunately move away from Sao Paulo now back to other places around the world. But thank you very much. Stella, just to let you know that there's a couple more questions for you in the chat, if you wouldn't mind answering. Gaurav and Harry have both asked questions, if you wouldn't mind, if you've got a chance to answer them. Stella, thank you.
I'll take a look.
Thank you. Okay, so we're going to move on now to our panel, actually. So this is the third part of the event this afternoon. First, we've got Christina Alejandro. She's president of Balibago Waterworks in the Philippines and also happens to be my boss. She has an extensive background in business administration and organizational leadership. Christina has guided her company in delivering innovative, sustainable water solutions across the country. She represents a dynamic example of private sector leadership, and I can thoroughly endorse that, in local service delivery, and is also a member of Aquafed's executive committee. Welcome, Christina. Secondly, we've got Babati Morgethi. Babati, I hope I've pronounced your name correctly. He's Senior Urban Development Officer at the African Development Bank, where he serves as the East Africa Regional Focal Point. With over 15 years of experience in urban planning and infrastructure development, Babati has led transformative projects across the continent, from Nigeria to Rwanda, for example, focused on livability, sustainability, and inclusive growth. His insights into regional infrastructure finance and urban governance will be particularly valuable for today's discussion. And finally, joining us from South Africa, we have Nathaniel Monetsi, Head of Structured Finance at the Gauteng Infrastructure Financing Agency. With more than 20 years of experience in investment and project finance, he oversees a $3.5 billion infrastructure pipeline spanning critical sectors like water, sanitation, transport, and education. His work bridges public sector needs with private capital solutions, making him a key voice in advancing blended finance models at the subnational level. So let's begin our roundtable discussion now. So I'm going to start with a few questions for each of our panelists. And also, if you have questions for them as well, please do put them in the chat, and we'll try to make sure as much as we can that they'll be answered. Let's start with Babati, who's going to provide us some regional perspective on local projects. Babati, you are there, I think. Yeah, I can see you. Great. Okay. So a question to you is, based on your extensive work across the African continent, how is blended finance currently being used to address urban infrastructure gaps? And specifically, are there any models or sectors where it's proving most effective, and the lessons that can be drawn from scaling these approaches across different cities? Babati, the floor is yours, please.
Thank you very much, Neil. I think from the AFDB, I think blended finance, it's proven to be an effective tool in addressing the infrastructure gaps that I think most of our cities experience. And I think as the bank and our partners, I think we are pioneering some of the innovative blended finance models to mobilize most of the private capital and complement the public resources. So one of the things that I think we are trying to do is, one is to catalyze private investment through risk mitigation instruments. For instance, I think you look at, we're combining concessional finance, that's grants, short loans from I think AFDB with commercial capital, and using tools like guarantees for some projects to enable private sector to come in, first loss capital, where we sort of maybe provide the first equity. That in a way it sort of helps private sector now to feel that the project's much de-risked. And also we have technical assistance grants. This in case in 2019, the bank set up the Urban and Municipal Development Fund, which I think in 2019 was only 5 million in the fund, which 2022, the replenishment went up to $50 million. I think this has proven to be very much critical in the sense that it enables cities to be able to have bankable projects, because one of the things that whenever for you to access financing, if you don't have that bankable project, you cannot be even having a conversation on financing. So I think currently in Kigali, we have a project of over $100 million, which was unlocked by that particular fund to assist the government, the city of Kigali, to prepare those studies, and then ultimately getting the financing, which they were able to get a concessional loan from the bank and also get grants from the climate action window within the bank. So I think in terms of, there's really quite a need to anchor some of these bankable infrastructures and the SPVs within the SPVs to allow cities, I think, to be able to leverage land value capture, recurring services, revenues, that is aspects like your tolling, your levies and utility tariffs. But all in all, I think we also have a targeted, I think, sector financing. I think, for instance, we have the Africa Water Facility. That is one of the facilities that I think we have sort of unlocked quite a number of projects within the continent to be able, I think the one that I think Akif already mentioned in the chat, the bulk water within the Kigali. Those are the facilities that the Africa Water Facilities within the bank is also supporting in that sense. I think, I believe without those project preparation facilities, most cities are not even able to be able to function or to be able to have projects that they can easily share either with private sector or with banks themselves. Thank you very much, Neil.
Thank you, Babati. I was so focused on what you were saying. I was swigging water and taking. You mentioned guarantees and first loss capital, right? And this is what we hear so often as classic instruments that can really make it work.
Yeah.
Why does this not happen more, Babati? What the answers are there, right? It's not even about trying to find silver bullets here, right?
Yeah.
They're there and they work, you know that. What is the blocker sometimes? Is it a lack of will from the government, I suppose? And I appreciate it's a big ask to kind of put a guarantee in place. Is that where it falls down, some at the political level more?
Not necessarily that. I think for me, the big thing that I would say it's the big challenge that I see is that most cities, they don't have a pipeline of projects that then they can come before a financier and say, I have this project. I think for instance, the bank approved in 2018 a subnational finance policy or guidelines to say we want now to interact or do business with the subnational entities. But one from the points that I think Stella mentioned, if you look at the case of State of Sao Paulo, it's fully autonomous. It's a different case in Africa. Cities that are autonomous or that have autonomy, that would be cities in Nairobi, but it's partial. Cities in Morocco, cities in South Africa. But the rest of Africa is still very much centralized. So it's not a question of the cities, they are not able even to come to an entity to say, I need this. It has to be the national government. So this is where I think there is a bit of that challenge but I'll sum it up to say lack of pipeline of bankable projects, I think for me is the key. Because if you have that pipeline, then it's easier now to say, I have this pipeline, understanding the perceived risk that Africa has. An institution like ourselves, AFDB, that's where we come in and say, okay, how do we ensure that this project comes to reality?
Yeah. Babati, thank you very much for answering my supplementary question. It wasn't planned, but it was just born out of what the things you were saying. And this problem of pipeline of projects and project development, just to say, if I can allow me for a second, this is something that Aquafed is trying to work on very hard now, and with governments to see in which ways we can help just move along the pipeline, the flow of projects, and we're trying to work very hard on this as well. So this is something I'd like to talk to you all about another day, perhaps. All right, let's move on. Babati, thank you very much for that. Christina, you're next, please. So over to you. Now you oversee water service delivery across a portfolio in the Philippines, and quite a diverse bunch of contracts that you have. Yeah, some sort of small ones and some really quite large ones as well, and quite difficult circumstances. Could you share with us some of the operational or financial challenges that you encounter in scaling water infrastructure at local level, and how you and your company have navigated them so far?
Hi, Neil, and everybody on this call. I am Christina Alejandra from Balibago Waterworks. We are the 4th largest private water utility in the Philippines. We have 92 municipal concessions under a PPP framework. And yes, we are a proud member of Aquafed. So to answer your question, in the Philippines, the operational challenge that we face is water rights allocation. Getting water rights in the Philippines is difficult because the Philippine government does not have an integrated water management or water resources management strategy. So the different water users are competing for water rights. And now the biggest allocation of water goes to irrigation, around 60%. Water for municipal use is only 10% of the total allocation. So in the Philippines, we are very much open to public-private partnerships in the water space, in the water sector. And there are many companies that are now entering the water sector, and it's becoming a competition. So each private company is trying to get water rights on their own, And how do we navigate this? Basically, we need to be forward-thinking, resourceful, creative, and competitive in acquiring water rights from our national government. No? On the financial side, the financial challenge is scaling on the bulk water project. So our company, Balibago Waterworks, is very successful at building water supply and distribution projects for small to medium municipalities, right? With populations from 20,000 to 150,000 people. Now, our water supply is mostly groundwater based, no? And this is economically feasible, right? But when the groundwater sources are starting to become scarce or have climate change issues like saline intrusion and or they dry up altogether, we now need to turn to surface water projects, big bulk water projects using rivers or desalination. And this is where the challenge is because when you, it's very capital intensive and the bulk water rates that the effective bulk water rates that are coming out to make the projects bankable are very expensive for the local market, right? And so some of the projects are pending simply because the risk of undertaking the project is pretty high. You know, the investment payback period is risky or questionable. So this is the current challenge we're trying to deal with right now. But how do we navigate this? Well, I have to say, if there are financial institutions or development funding that will accept internal rates of return around 8 to 10%, then these projects can be bankable. The bulk water rates will become affordable. And this will solve a lot of the water scarcity and access to water issues in the Philippines.
Christina, thank you very much. I was just going to ask you about, just go back a bit, and you were talking about the, I suppose, the lack of governance around water rights. And this is something for people who are outside of the water sector. You're probably completely bemused by the over politicization of water and at the same time the lack of actual organization of water. How much does that affect you, or does that affect the investors overall, or potential? Do they look at the Philippines and look at the structure and think, no, it's not really a kind of viable setup for us? Does it harm your chances?
Actually, there's so much interest in the Philippines right now. So there are many other countries like Singapore, Israel, Korea, Japan. They're all interested in investing in water and sanitation in the Philippines. So this water rights allocation is not really a detriment to them. I think that although the Philippines regulatory environment and governance is not perfect, our population of 110 million people makes us an attractive market. And there's still around 20% of the population that does not have safe access to water. So that gap, there's a lot of opportunities.
Thank you. And do you have local authorities that are willing to co-invest with you in a kind of blended way? Does that happen?
That's the problem. The local water utility administration does not have a lot of funding. So the public funding is not available. That's why a lot of the private sector is stepping in also in a big way.
Because you go to the local commercial banks, right? You are the darlings of the local finances, aren't you? Private finances.
Thankfully, thankfully the commercial banks have been supportive and they find the projects so far. Of course, we only propose those that are financially viable.
Yeah, brilliant.
Yeah.
Thanks, Christina. Thank you very much. I'm going to come back to you. Just while we were talking, Keith has put a good example, I think, of the Philippines Water Revolving Fund, which I'm sure you're aware of as well. Nathaniel, I'm going to come back to you in a minute, but I've got another question for Babati first, please, if you don't mind. Babati, back to you, because one of the main constraints for a PPP is to, I think we've mentioned already, to have a credit-worthy counterpart. And we've heard from infrastructure funds and other private players in previous sessions that project owners need to make themselves market ready and projects investable. Now, this is a big issue, again, as you alluded to, in many African countries and even more so at local level. So putting you on the spot a bit, can you give us your top three practical actions which municipalities and urban agencies can implement right now to make this happen? So that was a very long question. I hope you got that.
Thanks, Neil. I think first and foremost, cities and municipalities, they need to enhance the financial data transparency and actively seek ultimately the credit rating. I think from the presentation that Akif gave, you saw that for the bond, there has to be rating. So this ensuring that they have their detailed asset registries, infrastructure inventories, clear reporting on revenues and expenditure, that sort of and also that also will encourage them to proactively work on engaging with credit rating agencies. I think this step is very critical in building that credibility and enabling financiers to accurately assess risk. I think, like I already mentioned before, there is a huge perceived risk in Africa. And without all this financial transparency, that perceived risk will forever continue to be there. Secondly, I think for me to develop implementable and financially robust project pipelines with strategic narratives, translating those urban master plans into systematic, financial viable and bankable project pipelines. Detailed feasibility studies being prepared, which are clear on the expected returns and cost recovery mechanisms. I think that also builds on the transparency from the get-go, so that if, say, I am a developer, I'm coming in, I know the legality of it, how much am I getting, all those. And then I think lastly, which is one of the weakest points that I think most of our cities and municipalities optimize their own resource revenue generation and improve absorption capacity. You find that there isn't much of thorough gap analysis on their existing. They need to undertake that thorough analysis on their existing own resource revenues. Issues of property taxes, user fees, land value capture, and implement administrative policy reforms that enhances collection of efficiency and transparency. Those are one of the things. I think if you take, for example, a city like Nairobi, there is a huge potential in terms of the land value capture or the property rates. But currently, I think Nairobi, the property rates that are being used in Nairobi, they are from the 1980s. An acre, a person may pay 200,000 shillings per acre for the whole year. Yet that acre has 117 units, which per month, the rental that person is collecting per month in 1 unit, it's almost half what he pays for the whole year as the property rates. So that just shows that there's a huge mismatch. And if you have those gaps, that means your balance sheet as the city is not up to par. You cannot even start to have those engagements. So I think for me, those are things that I think cities across Africa really need to deal with. Also, simultaneously, they also need to improve the poor absorption capacity. You find the procurement processes strengthening their financial oversight to ensure that the allocated capital or budgets are spent effectively and on time. Because you realize, even through our project preparation facility, when it was set up, the bank decided to say, knowing the challenges of our cities, how do we ensure that if we allocate the funds, we will do the studies quickly, either we do it as bank executed, where we do the procurement on behalf of the city on our end, that sort of speeds up the process. But if you leave it to the cities, because of their non-streamlined processes, they can spend the whole year while they're just procuring. So by then, if there's a private partner who is standing on the sidelines willing to invest, but he needs those studies, the city needs to confirm some of the details on their own, the due diligence, the partner will move on. So those are the challenges. Those are the three for me that I think if cities can focus on, we should be able to find a way. Thank you very much, Neil.
No, thank you very much. And that was three very clear practical points. That was excellent. I'm going to have to go back to the video and hear those again. I think that was a real kind of coaching on teaching on how to do it, I think. Thank you very much. Nathaniel, if you are there, I think that you sort of same question to you in a way and what you've heard so far, but all these challenges that are being kind of thrown around at the moment, you're kind of the guy in many ways that's got to deal with them, right? How would you describe the process of Goten's journey towards creditworthiness and making the pipeline of projects investable?
Thank you, Neil, and good afternoon good day rather to all on the call. It's a very interesting question from an infrastructure project preparation point of view. I think the very first step that one has to take is we need to make sure that we understand the metrics of the project from a cost point of view, a revenue point of view. But where does that come from? That comes from having a comprehensive feasibility study to start with, which essentially should outline all the risk elements that are inherent in the project. You're looking at demand risk, design risk, construction risk, operations, and finance. And really, with that feasibility, it should then inform how you structure your PPP contract. And I just want to give one very good example in South Africa, where because of kind of like a weak credit risk profile on a project, the government had to take a step to support the project. I'm sure most of you who've been to South Africa are aware of the Houghton project, the fast-speed train between Pretoria and Johannesburg. Having conducted that feasibility study, I think one of the biggest challenges was around viability of the project financially. And because it was such a catalytic and strategic project, the government had to step in, both national government and provincial government, to make sure that the project is viable. So if you look at the financing structure of the project, you realize that on its own, the project was not going to be viable. So it's a very good example of blended finance in the sense that government provided almost 70% of the financing in the form of grant contributions to the project from the National Department of Transport. Gauteng is also to contribute some grant component. There is also some that is called a patronage guarantee in the project, in the sense that if the ridership falls below a certain threshold, meaning the project is not going to be sustainable, the Gauteng government steps in and provide that ridership guarantee to make sure that the project is viable. So it's really a way of making sure that projects are viable, number one, but also they are of very good creditworthiness. Then in recent days, we are developing a waste-to-energy project for the city of Johannesburg. And the key revenue drivers really were not sufficient to support the project. If you look at the regime in South Africa around gate fees for waste-to-energy plants, we are sitting at almost about 300 Rand per ton. And in terms of composition, 70% is gate fees, 30% is sale electricity. And we were not able to support that project from a viability point of view because you need your gate fee to be almost 3 times that level. And because of that, the National Treasury has got a window of something called Budget Facility for Infrastructure, where essentially they come in to support projects that are catalytic in nature, but are failing to get to the finishing line because of that lack of viability. So the project has now been supported up to a tune of 1.6 billion Rand, which essentially is an aspect coming in to support, to cushion the project, to make sure that it is viable. There is also about 500 million Rand that is also coming from the city of Johannesburg itself to make sure that the project is viable. So as we speak, it will be going into the tendering phase anytime between September and December of this year. So really, it's a blended finance in motion, blended finance in action to make sure that projects that are not creditworthy or not viable financially, they are supported from a government point of view, but we're able to push them forward in terms of their viability. Yeah, I think for now I can stop here, Neil. Thank you.
And Nathaniel, that's brilliant. Thank you very, very much for that. And I think there's going to be there's a few questions for you in the chat, but I'll come back to those in a minute. Nathaniel, thank you for this. I'm going to go back, if I may, to Christina actually. And there's another question for you, please. So given your experience in both private and community-based service delivery, how will you see blended finance ensuring impact and helping undeserved or smaller municipalities? Because this is very much your area of expertise. And kind of what types of support, either technical or financial, would make blended finance more accessible to operators like you?
I believe that blended finance has a great potential to close gaps in infrastructure in any sector, and most especially the water sector. The real challenge, and as mentioned before by Babati and Nathaniel, is really ensuring the projects are bankable and that risks are mitigated. For me, the answer to this is technical expertise, professional management, and knowing how to navigate imperfect regulatory environments. In the experience of Balibago Waterworks, if these three are present, right, as I said, technical expertise in the sector, really understanding how the business model works, right? What are the assumptions? What are the factors that make the project profitable, right? That is important. And professional management, people who will really ensure that every penny, every dollar, every euro spent goes into the right investments and not into indulgent or overpriced projects, right? And then also, again, navigating imperfect regulatory environments. So, it's so hard to expect regulators to be better and improve. But if you are creative and you know how to work with the regulatory environment, that will be a factor to your success. So for Balibago Waterworks, if these three aspects are present, many projects funded by blended finance will succeed.
Great, thank you very much. We're just going to, Nathaniel, can I come back to you on that question, please? About one of the things that Christina was just talking about was kind of imperfect regulatory environments. And then you work across a range of sectors, right? Have you, sorry to spring this one on you, but have you seen kind of which sectors have kind of the better regulatory frameworks that enable kind of blended finance to happen, do you think? And which are the good ones? I'm not going to ask you which the bad ones are, but which are the good sectors, do you think, or that have good regulation?
Thank you, Neil. I'm sure you follow the Renewable Energy Independent Power Producers Program in South Africa. So really, from that perspective, the energy sector in South Africa, I can say, is one of the sectors that has got the best in terms of regulation in allowing private sector to come in to participate. I think we've done almost 6 rounds of procurement, more successfully in that respect. I think it comes from a number of perspectives, really having a lot of dialogue prior to even creating the frameworks around how you procure the energy, who is the off-taker, because there is one single off-taker, which is Eskom, the main power utility. You also speak around guarantees around how then do you guarantee the tariff of the private sector when they come in as private participants. So that has been quite well structured. But I think most importantly, that has also made it easy for the financial sector to come in and support, because of all the support structures from a regulatory point of view, support structures from a off-taker point of view in the sector of energy. So I think based on that example alone and the success story of the REAP program in South Africa, I would say the energy sector is one of the best in terms of regulation. Thank you.
Nathaniel, thank you very much for answering my quite irritating question, but you have to forgive me. Regulators are one of my obsessions, so thank you very much for that. I've got a question for Akif coming to you in a minute. Akif, I don't know if you could see it in the Q&A already, but I'm going to give you the floor to answer it. There's a question from Stephen, but I'm going to come back to you. But first, I just wanted to go to Stella because I had another question actually about regulation. And first of all, Stella, thank you very much for taking the time to answer all the questions during the chat. You've given very wholesome answers there. Thank you. Stella, a question for you as well, though. What are the key legal or regulatory hurdles that still need to be addressed to unlock more private investment in local PPPs across Brazil? What are the regulatory barriers at the moment? It's the simple question.
Well, I would say that we need to improve guarantee mechanisms for subnationals mainly. There is a default risk for subnationals more than at the federal government level, so it's important. And the federal government is looking at it, and it is updating legislation to improve the tools that subnationals can reach out for guarantees. So I think that's key, and I believe it's a common issue among developing countries, as we can see throughout the panel. I believe that is what is missing to have more projects, more bankable projects here in Brazil at the level that our infrastructure deficit needs.
Great. Thank you very much, Stella. Thank you. Akif, I'm going to come to this. There's quite a long question. Did you manage to read it? It's going to take me about 2 minutes, but it basically says, in a nutshell, it says, there's a question for Akif from Stephen Sino. It's a great question. In Kenya, there is a strong economic regulator for commercial public water utilities. Kenya is increasingly interested in PPPs, including private initiated proposals for bulk, mixed-use wastewater, fecal sludge management, etc. As PPPs are highly dependent on reliable tariff revenue and the regulator has a mandate to ensure the public interest, in the eyes of the private investor, is the regulator seen as a benefit or an obstacle? And when should the regulator engage in the PPP preparatory process? Akif, over to you.
And Stephen also made an interesting comment earlier when he mentioned that this is all about financial structuring. This is not about one tool being better or worse than the other. And oftentimes we see transactions that have guarantees, that have subordination within the capital structure, viability gap funding. They might have benefited from a design grant at the outset. So this is all about complete financing package. With respect to regulators, it really depends on which regulator you're talking about, which sector, which country. Not all regulators are made the same. But yeah, you're absolutely right. Like, for me as an investor, what do I want? I want to be able to model my cash flows. What do I need? Predictability. What does regulation offer? Hopefully predictability, but in certain countries, in certain jurisdictions, several of them on this continent, it is not so predictable. And regulators are, there is a lot of political undertones to regulation, specifically in the water sector. So in the context of Kenya, for example, having a stable regulatory regime with, a good understanding of what the offtake risks and the challenges are, a good understanding of tariff escalations, a good understanding of local content regulations and so on. That's something that investors want. And oftentimes you see regulators chopping and changing. Oftentimes regulators don't have the capacity even to regulate the sectors that they are in charge of regulating. So it really depends on the kind of regulator. And Kenya does have a better regulator in the water space compared to some of the other jurisdictions in Africa. We won't go there. So from that perspective, if I was an investor in the water sector in Kenya, absolutely. A regulator would be, stable regulation is viewed as something that is important. And I would take a very positive view towards the regulator here in Kenya. As to when they come into the process, I think that's something for the project developer to work on right from the outset, because oftentimes regulations catch up to the structuring and to a lot of the financial mechanics and the financial engineering of a specific transaction. I've very rarely seen regulators be ahead of the curve. The innovation is always emanating from the private sector, with the regulators playing catch up.
Keith, I want to thank you for making that point at the end about the developer being involved right from the start. That's actually one of our, things we believe so strongly at Aquafed is like, do not wait. Exactly. We are, as developers, we are ahead of the curve, and it's our job, I think, and our responsibility to help the regulators along, help them to understand and actually try and kind of control that in the right way, I think. Right. Thank you, Akif, very much for that. There's another question that we had actually. I want to go back to Nathaniel, and it's actually something I think it's a really important question, excuse me, which is how other African countries and local governments can set up an agency like yours, because it's really, really useful, and we wish we saw this much more, actually. So Nathaniel, how was it set up? How did, if you were involved in it, how did you do it?
Yeah, thank you very much. Maybe let me just give background and context. So the GIFA is a component of the Gauteng provincial government, which essentially assists provincial departments and municipalities to prepare, structure, and package projects for alternative financing, much of which is around public-private partnerships. In terms of its mandate, really, like I said earlier on, to support municipalities and provincial departments. So in the setup, I think first of all, you need some very good or rather strong political support, which first of all, there has to be a strategic admission that on balance sheet financing on its own is not going to work. You would need an alternative that is PPPs. And that's first and foremost. Then the most rather underpinning part of that is you need financial backing for the entity. Financial backing in the sense that preparing projects is not a walk in the park. It takes time, it takes resources financially. So you need to make sure that there is very strong financial backing to make sure that the entity is operational, number one, but also in terms of supporting the mandate. So the GIFA receives its grant allocation for feasibility studies, hiring of consultants from the provincial government on a regular basis so that it's able to fulfill its mandate. But a creative aspect of the GIFA is around the fact that it works on a revolving fund that makes sure that for every project that gets to financial close, you are able to plow back the recovered funds into the project preparation fund. Then you also need the expertise, you need the skills, you need the right skills on board because, like I said earlier on, project preparation is not a walk in the park. You need the right skills technically, financially, and legally. And the beauty about South Africa is beyond just the internal resources, there is a very strong network of consultants and technical advisors who are able to support the process. And at the center of it, you also need a very strong pipeline of projects that you're going to be developing as PPPs. So in our case, there is a master plan that was conducted around 2014, which is called the Gauteng Integrated Infrastructure Master Plan. And in that master plan, we realized that the province had a gap of 1.7 trillion rand in terms of closing our infrastructure gap. Yet the budget for the province on an annual basis is 150 billion rand. So much of that is going towards operational expenses. The only way out is on PPPs. So you need that strong pipeline to make sure that the sustainability of the entity. Then you need also a supportive landscape for co-funding because government does not have unlimited supply of funds. So in the case of South Africa, there is the Development Bank of Southern Africa, it's a DFI. There is also the IDC. So on some projects, we work together to co-fund. It also helps to make sure that there is buy-in from the DFIs, commercial banks, and everyone else. It helps to crowd in commercial capital. And more recently, the government itself at a national level introduced something called Infrastructure South Africa, which in essence is also a GIFA, but at a national level, which supports also with project preparation. So we work as a club in making sure that our projects are well prepared and well packaged for private investments. So I think those are the critical elements that you need to make sure that you set up an entity such as GIFA, and to make sure that it is sustainable in its operations. Thank you.
Nathaniel, thank you very much. And again, you touched on another key theme that we hear consistently in all these discussions, which is about the need for a master plan from the authority, basically, right? You just cannot move forward without this kind of plan or vision of what's needed first. And without that, it's just so hard. It's really, really hard. And it sounds like such a basic thing, but it's not at all. And it's so fundamental. So thank you again for raising that point. And there's actually another question for you, Nathaniel. You can't go just yet, I'm afraid. There's a question from Ursula, I think, who is saying, at which stage are the consultancies usually contracted?
Thank you very much. Consultants are usually contracted right at the beginning of the project, meaning as we are going into feasibility, you need to make sure that you've got the right team of consultants to assist you with the feasibility work, but they must also have a clear understanding of the regulatory framework within South Africa. Its PPPs are governed under Treasury Regulation number 16 of the Public Finance Management Act of 1999. So these consultants must have a clear understanding of that process from feasibility, procurement, all the way to financial close. So they are normally procured right from the beginning at feasibility. In some instances, we try to split because you are not so sure about where the project is going. You procure a consultant to only conduct feasibility. Then later on, post-feasibility, you then go to market again to procure a consultant that will take the project from procurement to financial close. But usually it's beginning of the process. Thank you.
Thanks. So in my simple mind, it's really clear, right, from what you've said and others, is that if you want to get a project to work, you get all the people around the table right at the beginning, right? Regulators, developers, finances. It's just so damn obvious, isn't it? Right? Okay. Nathaniel, thank you very much for that. There is a question for the panel, actually, from Uven, who is saying, this is a bit more of a technical question, away from my simplicity, right? This is a proper question. Can municipalities consider longer amortization for concession assets, municipal asset schemes, and rate reduction benefits for projects to supplement shortfalls for CapEx? So let me just say that again. So can municipalities consider longer amortization for concession assets, municipal assets, and rate reduction benefits for projects to supplement shortfalls for CapEx? Does anyone want to try to attempt to answer that question?
Thanks, Neil. I think yes, they can. However, I think there are key preconditions that I think they need to be cognizant of, or that need to be in place. If long-term amortization, one, it means long-term revenue visibility. That needs to be something that is already there. The tariffs, the lease payments, stable, legal, and regulatory environment, so that as an investor or a partner who comes in, I know I don't foresee any changes in the nearby future. And the municipality's ability to enter into long-term contracts, that's the PP laws or the frameworks, that will be the precondition for those amortization. In terms of municipal transfer assets, I think it will be clear land tenure and asset registry. I think it goes back to that having their systems in place, transparent asset valuation framework. Also, those are things that basically need to be in place for you to be able to start looking at these tools. And I think lastly, the rate reduction for me to be more of a where you are looking at the predictable municipal revenue streams and ability to commit to the future fiscal support. That is, in an instance, you don't meet that, can you be able to support? So I think, yes, it is a possibility, but they still need to get the governance in place within our cities and our municipalities. Thank you very much, Neil.
No, thanks to you, Bawati, for answering that question. I really, really appreciate it. Thank you. It's, again, a very thorough answer. Uven, I hope that has helped you with your question. I'm gonna give you about a 2-minute warning, right? I'm gonna come to you in about 2 minutes to summarize somehow all this wealth of information. I've written so much that my pen has run out, and that's not a joke. But before we do, Keith, just one last question for you, please. It's a long question. I'm expecting you to answer in about a minute, which is impossible. Well, let's try it, right? So from your vantage point at Convergence and your work across the 3 continents you've worked on, Africa, LATAM, South Asia, what are the most common blended finance models being deployed at local level?
You want the good news first or the bad news?
Let's go for the good news first, Akif.
Okay, well, the good news is that you have models that are replicable across continents, all right, and across sectors as well. Let me give you an example. Ultimately, what we're talking about is infrastructure. What does it have in common with other infrastructure assets? A life cycle approach. Therefore, you have in the past seen life cycle approaches to blending to support the water space or the energy space. So, for example, a donor-funded pool of project preparation funding, a tiered equity structure that has some concessional capital that de-risks senior investors in the equity fund that invests in the early stages of these transactions. And then maybe a commercial refinancing fund that's on pure commercial terms that refinances the projects once they have cash flows and once these purchasing agreements have been signed. So essentially what you have is a life cycle approach to financing. We've seen that in Latin America and the energy space. We've seen that in the water space in Asia. You know, you could take these ideas and ultimately bring them to the water space in Africa, for example. So that's what we need. That's the first thing. Now, the bad news, Neil, because you asked for that second, is the amount of concessional money in the system is diminishing. The amount of soft money, concessional money is diminishing, and that's something that we need to be cognizant about. So we need to be better stewards of the money that exists, and we need to bring in other sources, including from governments themselves. I know balance sheets are stretched in Africa and Latin America and Asia, but we need governments like in Gauteng, for example, or we've got Ghana Infrastructure Investment Fund here on this call as well. These are examples of governments putting skin in the game. That's what you need as a signaling effect for investors, not Green Climate Fund and USAID and FCDO. All that's great. But it'd be nice to bring in, the Bandezes of the world and others to really put skin in the game and act as a signaling device for investors. So that's what we need. Signaling from local governments and a life cycle approach to investing.
Right, Akif, I think you must have been media trained or something, because your answers are excellent. They're precise, bang on the money, and that's so. Thank you very, very much, Akif. That's really, really clear. Again, this last point I'm really struck by. This thing, this diminishing concessional finance, lack of aid around the world. What happened to USAID and the Swiss and others. It's been signaled for a long time. What happens next? And you're saying, governments have got to put skin in the game. That is a really, really clear answer. Akif, thank you very, very much for that. Okay. Jinan, the floor is yours to summarize some of these, 1,000 points. I was just going to say to Jyoti, actually, and you and to Caroline, I think we've got enough material for a webinar series for the next 5 years from this session, quite honestly. So thank you to all the panelists for all your help. Jinan, the floor is yours.
Yeah, no, thank you very much, Neil, and thank you for the panelists. Like all of you, you've brought up I would say deep technical and practical points for everyone, and I think this is very useful because, as Jyoti mentioned at the beginning of the session, we're taking all of these insights, remarks, also live examples, and putting them in policy briefs, basically just to help everyone. Whether advisors, governmental entities, also investors, just to see how this can be translated to actions. And of course, at the end, we want these webinars and what we've been discussing here to be applicable and practical, as much as possible. I don't want to go really to these deep technical remarks and what have been discussed here, but I think from my perspective and what have been discussed today, based on these real life examples that we heard, I think this is a real example that on a municipality level or on a local level, these stories also help us understand that practicality of infrastructure is coming really from this local level. And And also, what I'd like to say maybe is that on a local level, you are on proximity and you really understand the need and the mandate and how to deliver solution. And I think our role, basically in WAPP, and also our role, all of us as advisors, investors, and policy shapers, is to create these enablers and mechanism on how to enable these local government to translate these projects to life. In WAPP, we're taking a short break here from the webinar series during the summer holidays, but we will continue to engage on LinkedIn basically, and also progress on this program and the other initiative and resources. So we encourage you to follow us on LinkedIn. We will be publishing like updates, blogs, and policy briefs, as I mentioned, just to continue on this discussion throughout the year. Our next webinar will take place on September 18, 2025, and we will continue to unpack these critical themes around PPPs, blended finance with fresh perspective and also case studies. Thank you again, and we really look forward for the next webinar after the break. Jyoti, if you want to just conclude also from your perspective.
Thank you, everyone. I just want to say this was such a fast-paced session. I'm just so impressed with the audience posing questions and the panelists answering live and typing your answers. And it's just so much to unpack. As Neil said, all the examples were excellent, and there were so many things which actually can be scalable and replicated across the regions. And that's what really amazed me. So please, we are taking a break for the summer for July and August, so we'll be back in September. Please continue to engage with us through LinkedIn and through other social media. But the idea is really to engage with all the practical examples which are out there to promote public and private partnership. Thank you so much, and let's give an applause to our panelists and Neil, our moderator. Excellent job.